Hi, I'm Dylan Potter, a partner and wealth manager here at Howe & Rustling. Today we're going to be talking about I-bonds. So much of the bond world has been thought of as sort of a sleepy backwater, no offense to our bond team. But in the face of rising rates and inflationary pressures, inflation-protected U.S. savings bonds, often referred to as I-bonds, have become more mainstream. In today's Street Smarts, we're going to dive into the world of I-bonds and hopefully inform you to make the choice as to whether they should be an addition to your financial toolkit. So, diving in. I-bonds are a bit of a unique animal. They're issued by the U.S. Treasury to protect your money from losing value due to inflation. The interest rates on I-bonds are adjusted twice per year to keep pace with rising prices. In addition, I-bonds are exempt from state and local income taxes, which makes them an even better low-risk investment for investors who live in high-tax states and cities. An I-bonds rate combines two different rates, a fixed rate and an inflation rate. The fixed interest rate remains the same throughout the bond's entire life. Its inflation rate is announced by the Bureau of the Fiscal Service and can change twice per year in May and again in November, and it's really tied to the rise or fall of the Consumer Price Index for all urban consumers, or CPIU. The combination of an I-bond's fixed rate and inflation rate creates its composite rate. This is the interest rate an I-bond will actually earn. Currently, and we're filming this around the middle of August, I-bonds are offering a composite rate of about 9.6%. So just to summarize in plain English, the bond's yield is a reflection of inflation. If inflation continues to remain strong, the bond will provide a higher yield. If inflation falls, the bond's rate will also fall. While they offer a great rate in today's environment, you can only buy them on treasurydirect.com, and you must have a Treasury Direct account. While the site looks very old, it's fairly straightforward to use. Again, we cannot do this for you at Howe & Rustling, nor can any custodian like Charles Schwab or Fidelity. Each year, you are limited to $10,000 in I-bond purchases per individual, plus an additional $5,000 per year in paper I-bonds with your federal tax refund using IRS Form 8888. If you do make estimated quarterly federal income tax payments, some may want to consider intentionally overpaying them and then taking up to $5,000 of that resulting refund in the form of paper I-bonds. If you do receive the paper I-bonds, you can then convert them to an electronic form. But let's talk about a couple key points to think about. I-bonds do not trade in the secondary market. So if you need to convert them back to cash, you redeem them directly through your Treasury Direct account. I-bonds have a maturity of 30 years. They carry a 20-year original maturity period, immediately followed by a 10-year extended maturity period. It's very, very important to note that I-bonds cannot be cashed for 1 year after purchase. If a bond is cashed in year 2 through 5 after purchase, the prior 3 months of interest is forfeited. There is no interest penalty for cashing in the bonds after 5 years. So if you do have excess cash that you are confident that you will not need within 1 year, it may make sense to lock in the nice current yield by using some I-bonds. Like I said at the beginning, we cannot purchase these for you, neither can your custodian or any advisor that you may work with. So other than the antiquated website and the illiquidity of that investment during the first year, I-bonds can be a great addition to any individual's toolkit, particularly in this inflationary environment. Thanks for joining us on this episode of Street Smarts. If you have any further questions about inflation-protected bonds or I-bonds, don't hesitate to reach out.